Right now, the average American is paying $2,678 a year just to insure their car. That's not a luxury expense. That's more than some people's rent. And here's the thing that should really make your stomach turn. According to the Bureau of Labor Statistics, insurance premiums have jumped over 30% since 2023. 30%. Let that number sit with you for a second. And it's not just car insurance. According to Maddox 2025 Home Insurance Trends Report, the average home insurance premium now sits at $1,966, a 9.3% jump from last year alone. So whether you own a house, drive a car, or have a life insurance policy, you are bleeding money right now. And most of you don't even know it. But here's what I'm going to do for you today. I'm going to walk you through exactly how to slash these costs, step by step, no guessing, no confusion. And by the end of this video, you're going to have a clear blueprint to save hundreds, possibly even thousands of dollars every single year. And later, I'm going to share one strategy that most people have never even heard of. Stay with me. So why is everything going up? Let's break it down. According to Bankrate's insurance analyst Shannon Martin, insurance is reactionary. That means the price hikes you're seeing now are insurance companies trying to recover from losses they suffered over the last few years. Between 2020 and 2024, things like replacing a cracked bumper, fixing a dented fender, or swapping out a damaged windshield all went through the roof because of inflation. On top of that, car crash fatalities jumped over 10%. Extreme weather events, wildfires in California, flooding in Texas, hurricanes ripping through the Gulf Coast. All of that is hitting your wallet. According to Insurify's 2025 forecast, prolonged tariffs could push premiums up another 8% by end of year. So, the system is designed to take more from you every year. But here's the good news. The system also has built-in escape routes. There are discounts, strategies, and little-known tricks that can bring your costs down dramatically. You just need to know where to look, and that's exactly what we're about to cover. Let's get into it. This is the single most important thing you can do, and I cannot stress this enough. According to Consumer Reports' 2024 survey of over 40,000 policyholders, people who switched insurance companies saved a median of $461 a year. That's not the maximum, that's the middle number. Some people saved way more. One couple from Kentucky, they were about to get hit with a 28% rate increase. Their annual premium was jumping from $4,983 to $6,374. According to AARP, they called their insurance broker, shopped around, switched providers, and saved $2,680 in one move. So think about it this way. Instead of just accepting that renewal letter that says your car insurance is going up, you pick up your phone, you call 3 or 4 different companies, you go on websites like Compare.com or Insurify or The Zebra, and you get quotes. That one afternoon of work could put hundreds of dollars back in your pocket. According to CarInsurance.com, car owners who reshop their policies save an average of $694 a year. Do not skip this step. Now, some people hear switch companies and they think, but I've been with my insurer for 10 years. Doesn't loyalty count for something? Here's the honest truth. In most cases, no, it does not. Insurance companies can charge wildly different premiums to the exact same driver with the exact same car and the exact same record. According to CNBC, some industry insiders actually recommend switching car insurance companies every single year to take advantage of these massive rate differences. Your current insurer might be raising your rates while a competitor is holding steady or even lowering theirs. You'll never know unless you check. Imagine you're buying groceries. You wouldn't keep going to the same store if it charged you double for the same bag of rice that's half the price down the street, right? That is exactly what's happening with insurance. You're paying more out of pure habit. Break the habit. Shop around every year. Set a reminder on your phone 2 weeks before your policy renewal date. Compare at least 3 different providers. This one habit alone can save you thousands over a lifetime. Now, here's something that shocks a lot of people. Your credit score has a massive impact on how much you pay for insurance. Most people don't even know this. According to Bankrate, drivers with poor credit pay on average 105% more for full coverage car insurance than those with excellent credit. Let me say that again. 105% more. And it's not just car insurance. According to the Consumer Federation of America, a typical homeowner with a low credit score pays nearly $2,000 more per year for home insurance than their neighbor with a high credit score. That's almost double the price for the same house, on the same street, with the same risk of flooding or fire. And here's the part that's going to blow your mind. That same Consumer Federation of America study found that having a low credit score is often more expensive than living in a high-risk disaster area. So you could live in the safest part of the country, but if your credit is bad, you're paying the same as someone in a hurricane zone. That is wild. And it means that improving your credit score is one of the most powerful things you can do to lower your insurance costs across the board. So let's talk about what actually goes into your credit-based insurance score, because it's not the same as your regular FICO score. According to the National Association of Insurance Commissioners, insurers look at 5 main areas. Payment history carries the most weight at 40%. Outstanding debt is 30%. Credit history length is 15%. New credit inquiries are 10%. And your credit mix is 5%. So what does this mean in real life? It means things like paying your phone bill on time, keeping your credit card balance under 30% of your limit, not opening 5 new store credit cards during the holiday season, and having a mix of different credit types like maybe a car loan and a credit card rather than just one type. All of that affects what you pay for insurance. According to Nationwide, 92% of all insurers now consider credit when calculating auto insurance premiums. So this isn't some small thing. This is the industry standard. And the best part? About half of existing customers actually pay a lower premium because of their credit score. You want to be in that half. All right, so how do you actually fix your credit to bring those premiums down? First, go to annualcreditreport.com. That's the official site. You can get a free credit report from all 3 bureaus, Equifax, Experian, and TransUnion, once every 12 months. Check for errors. Mistakes on your credit report could be inflating your insurance costs right now without you even knowing. Second, set up automatic payments for your recurring bills. Things like your electricity bill, your internet bill, your phone bill. Because the number one factor in your credit-based insurance score is payment history. One missed payment on your credit card or your utility bill can drag your score down and push your premiums up. According to the Zebra, improving your credit by just 1 tier can lower your insurance rate by an average of 54%. 54%! So if you go from poor credit to fair credit, that's like going from paying $600 a month on a car loan to paying $300 for the same car. This is not a small change. This is life-changing money. And I'm going to show you even more ways to save. Keep watching. This next strategy is simple but incredibly effective. Raise your deductible. According to the Insurance Information Institute, increasing your deductible from $500 to $1,000 can bring your annual premium down by 20 to 25%. That's potentially $400 to $500 saved every year. Now, what is a deductible? It's the amount you agree to pay out of pocket before your insurance kicks in. So if you're in a fender bender and the repair costs $2,000, with a $1,000 deductible, you pay the first $1,000 and your insurance covers the rest. With a $500 deductible, you pay less up front, but your monthly premiums are higher all year long. Here's the key question. Can you afford to pay that higher deductible if something happens? If you've got an emergency fund sitting in your savings account, maybe $1,000 or $2,000 set aside for unexpected expenses, then raising your deductible is a no-brainer. According to Consumer Reports, the average driver doesn't file a claim more than about once every couple of decades. So you're paying higher premiums every month for something that almost never happens. Flip the math in your favor. All right, this one is like finding free money on the sidewalk. If you have your car insurance with one company and your home insurance with another, you are leaving money on the table. According to Insurance.com, bundling your home and auto insurance saves you an average of 18%. And some companies go even further. According to American Family Insurance, customers who bundle home and auto insurance can save up to 40% on both policies combined. 40%! That includes multi-product discounts, auto-pay discounts, and paperless billing discounts all stacked on top of each other. So instead of having your car insurance with Geico, your home insurance with State Farm, and your renter's insurance with somebody else, you call one company, put everything together, and boom, instant savings. It's like buying your shampoo, your conditioner, and your body wash in one bundle pack at the store instead of buying each one separately at full price. It costs less, and it's easier to manage. Call your insurance provider today and ask about bundling options. If they don't offer a good deal, switch to one that does. Now, this next one is the strategy I told you about earlier, the one most people have never heard of. It's called telematics, and it could save you a lot of money. According to Consumer Reports' 2024 survey, only 28% of policyholders even knew their insurance company offered a driver monitoring program. Most people have no idea this exists. So what is telematics? It's a program where your insurance company tracks how you actually drive, using either a small device you plug into your car or an app on your phone. They look at things like how fast you drive, how hard you brake, whether you use your phone while driving, and what time of day you're on the road. If you're a safe driver, you get a discount. According to Cambridge Mobile Telematics, 72% of telematics customers saved at least $100 on their premiums in 2024, and 21% saved over $300 per year. The maximum discounts from major companies range from 15 to 40%. That's huge money just for driving the way you probably already drive. Let me break down what each major company offers. According to Consumer Reports, Allstate offers up to a 40% discount. Nationwide also up to 40%. Liberty Mutual up to 30%. State Farm up to 30%. USAA up to 30%. Geico up to 25%. And Progressive reports an average savings of $231 per year for their Snapshot users. Now here's the thing. Some companies, including Allstate, Liberty Mutual, and Nationwide, will even give you a 5 or 10% discount just for signing up. You don't even have to prove anything yet. You just enroll and boom, instant savings while the program collects your driving data over the next few months. According to an AutoInsurance.com study, 2 out of 3 telematics users said they noticed a decrease in their monthly premiums after enrolling. The median savings? $27 per month, or $324 a year. So picture this. You download an app, you drive to work like you normally do, you pick up your kids from school, you go to the grocery store, and at the end of the month, you've saved $27 for doing nothing different. Now I know what some of you are thinking. But wait, they're tracking me? They know where I drive? They know how fast I go? And yes, that is a valid concern. According to a 2024 J.D. Power survey, only 22% of consumers said they were very comfortable with telematics tracking. So most people are at least a little uneasy about it. But here's what you need to weigh. According to the same AutoInsurance.com study, 51% of drivers said the cost-saving benefits could potentially outweigh their privacy concerns. And remember, most telematics programs are completely voluntary. You opt in. You can usually opt out if you change your mind. So think of it like this. You already carry a smartphone that tracks your location everywhere you go. Your GPS knows where you are, your social media apps know your habits, your search engine knows what you're interested in. The difference is, none of those apps are paying you for that data. Telematics is one of the few situations where your data actually saves you money. It's worth considering. Here's another strategy that's becoming more popular every year: pay-per-mile insurance. If you work from home, if you take public transport, or if you just don't drive very much, you could be massively overpaying for car insurance. Traditional policies charge you the same whether you drive 5,000 miles a year or 50,000 miles a year. But pay-per-mile programs, they charge you a base rate plus a small fee for every mile you actually drive. The less you drive, the less you pay. It's that simple. And with more people working remotely than ever before, this option makes sense for millions of drivers who are still paying full-price premiums for cars that sit in the driveway most of the week. Imagine you work from home 3 days a week. Your car just sits in the garage on Monday, Wednesday, and Friday. But you're still paying the same premium as someone who drives 40 miles to work and back every day. That doesn't make sense, right? Ask your insurance company about low-mileage discounts or pay-per-mile programs. Some companies, like Metromile, specialize in this. If you drive under 10,000 miles a year, this could cut your premium significantly. This one is so simple that people overlook it. Take a defensive driving course. Many insurance companies offer discounts of 5 to 15% for completing an approved driver safety course. And some of these courses can be done entirely online in just a few hours. So instead of spending your Saturday afternoon watching random videos on social media, you take a 4-hour online driving course. You print out your certificate, you email it to your insurance company, and your premium drops. That 4 hours of effort could save you $100, $200, even $300 over the next year. This is especially useful for younger drivers and older drivers. According to Consumer Reports, organizations like AAA offer programs specifically designed for mature drivers to help them adapt their habits, sharpen their skills, and qualify for premium reductions. If you're over 55, definitely look into this. Many states actually require insurers to give you a discount if you complete a qualifying course. Let's shift to home insurance now, and this is a big one. According to multiple insurers, installing a home security system can lower your home insurance premium by 5 to 20%, depending on what you install and which company you're with. That's potentially hundreds of dollars in savings every year. According to Mercury Insurance, homes equipped with fire safety tools like extinguishers, smoke alarms, and sprinklers can qualify for savings of up to 8.5%. Add deadbolts and a burglar alarm, and you could stack another 2% on top of that. And if you combine multiple safety devices, the discounts add up. So think about it practically. You go to a hardware store, you buy a set of smart smoke detectors for maybe $80 total, you install a Ring doorbell for about $100, and you put deadbolts on your front and back doors. Total investment, maybe $250. But your insurance premium drops by $200 a year. By year 2, you've made money on the deal, and your home is safer too. That's what I call a win-win. And it doesn't stop at basic security. Smart home technology is becoming a gold mine for insurance discounts. Water leak detection systems can earn you an additional 5 to 10% discount on your home insurance. Why? Because water damage is one of the most common and expensive insurance claims out there. Imagine a pipe bursts in your basement while you're on vacation for 2 weeks. By the time you get home, the damage could be tens of thousands of dollars. But if you've got a smart water sensor that detects the leak immediately and even shuts off your main water supply automatically, that disaster never happens. Insurance companies love that because it means fewer claims they have to pay. According to U.S. News, some providers even offer green home discounts if your home is certified by programs like LEED. And wind mitigation credits are available in hurricane-prone states if your home meets certain resistance standards. The point is, there are dozens of discounts available for home improvements. You just have to ask your insurer which ones they offer. Write them down, and then start checking them off one by one. Your roof is one of the biggest factors in what you pay for home insurance, and most people have no idea. According to Maddox's 2025 report, roof-related claims cost nearly $31 billion in 2024 alone. That's up 30% from 2022. Insurance companies are paying very close attention to this. The data shows that the premium difference between homes with roofs under 5 years old and those with roofs 11 to 15 years old was just $49 in 2022. But by 2025, that gap widened to $155. So the older your roof, the more you pay. And this gap is getting wider every year. According to Insurance.com, a roof upgrade alone can earn you an average discount of 11%. And upgrading your electrical, plumbing, or heating systems, that's worth an average discount of 13%. So if your roof is 15 years old and showing signs of wear, replacing it isn't just about keeping rain out of your living room. It's about keeping hundreds of dollars in your bank account every year through lower premiums. Did you know that the biggest single home insurance discount is for owning a new home? According to Insurance.com, this discount can be as high as 40%. 40% off your home insurance just because your house is newly built. That's massive. Why? Because new homes have updated wiring, modern plumbing, current building codes, stronger roofing materials, and better fire resistance. All of that means fewer claims for the insurance company, and they pass some of those savings on to you. Even if you're not buying a brand new home, recent renovations can qualify you for similar discounts. So let's say you just finished remodeling your kitchen, and you replaced all the old wiring in the process. Or you put in new copper plumbing to replace those rusty galvanized pipes. Don't just admire your new kitchen. Call your insurance company and tell them about it. They may lower your rate because your home is now less risky. Most people forget this step. Don't be most people. This sounds obvious, but it's worth saying clearly. The fewer claims you file, the less you pay. Many insurance companies offer what's called a claims-free discount that rewards you for not making claims over a certain period. And filing small, unnecessary claims can actually raise your rates more than the payout is worth. Picture this scenario. You've got a small scratch on your car from a shopping cart in the parking lot. The repair costs $400, and your deductible is $500. You file a claim anyway because, well, you're paying for insurance, right? Wrong. That claim goes on your record. And when your policy renews, your premium goes up by $200 a year for the next 3 to 5 years. You just lost $1,000 trying to save $400. The smart move? Pay for small repairs out of pocket. Save your insurance for the big stuff, the serious accidents, the major storms, the real emergencies. Your future self will thank you when your premium stays low year after year while everyone else's keeps climbing. Now let's talk about life insurance, because a lot of people are overpaying here too. According to CBS News, one of the most common mistakes people make is overestimating how much coverage they actually need. Too much coverage means unnecessarily high premiums. Think about when you first bought your life insurance policy. Maybe you had a big mortgage, small kids at home, and a lot of debt. But now, maybe the mortgage is almost paid off, the kids are working, and you've built up some savings. Your coverage needs have changed, but your policy hasn't. You might be paying for $500,000 in coverage when you really only need $200,000. According to the same CBS report, taking the time to reassess your current financial situation, outstanding debts, and future needs can lead to significantly lower premiums. Review your policy at least once a year, and if your life circumstances have changed, adjust your coverage. This one step alone could save you $50 to $100 a month. Here's something the insurance industry doesn't love talking about. Term life insurance is almost always cheaper than whole life insurance. Significantly cheaper. For the same amount of coverage, a term policy can cost you a fraction of what a whole life policy charges. So what's the difference? Think of term life like renting an apartment. You pay for a set period, say 20 or 30 years, and if something happens to you during that time, your family gets the payout. Whole life insurance is more like buying a house with a massive markup. You're paying more because there's a savings component built in, but the returns on that savings are usually pretty low compared to investing the difference yourself. For most people, especially younger families, a term life policy combined with smart investing gives you way more value. You get the protection you need at a fraction of the cost, and you invest what you save into something with better returns. Talk to a financial advisor about whether term insurance makes more sense for your situation. It almost always does. Here's something powerful. Your health directly impacts your life insurance premiums. According to CBS News, insurers consider factors like your weight, blood pressure, cholesterol levels, and overall health during underwriting. Making positive lifestyle changes, like eating better, exercising regularly, and quitting tobacco, can lead to lower premiums. This is one of those beautiful situations where what's good for your body is also good for your wallet. Quit smoking and your life insurance premium can drop dramatically. Some insurers charge smokers 2 to 3 times more than non-smokers. 2 to 3 times. So quitting doesn't just add years to your life, it adds dollars to your bank account. Think about it this way. You start walking 30 minutes a day, you swap out soda for water, and you quit smoking. 6 months later, your blood pressure is lower, your cholesterol is better, and your BMI has improved. You go to reapply for life insurance, and suddenly you're in a better health category. Your monthly premium drops from $150 to $80. That $70 a month you just saved? That's $840 a year just for taking care of yourself. Here's a little secret that insurance companies don't advertise loudly. According to CNBC, many insurers charge a fee for dividing your premium into monthly payments. That means if you're paying month to month, you're actually paying more than the total annual cost of your policy. Think of it like buying something on layaway versus paying cash. When you put something on layaway, the store sometimes adds a service fee. Same thing with monthly insurance payments. You might be paying $10, $15, even $30 extra per year just for the convenience of spreading the payments out. Over 5 years, that's an extra $75 to $150 for nothing. If you can afford to pay your full premium upfront at the beginning of the year, do it. You eliminate those processing fees entirely, and some companies even offer a small discount for paying in full. If the full annual amount is too much at once, see if your insurer offers a semi-annual payment option that usually has lower fees than monthly. Every dollar counts. This one takes about 2 minutes and it's pure savings. Many insurance companies offer discounts for going paperless. Instead of receiving your policy documents, bills, and statements through the mail, you opt to receive them electronically. Simple as that. So you log into your insurance company's website, you go to your account settings, you check the box that says Go Paperless or Electronic Delivery, and boom! You might save $5, $10, or even $15 a year. Is it a lot? No. But it's free money for doing something that's actually more convenient anyway. Why would you not do it? And here's the thing. This is one of many small discounts that add up. Paperless billing here, auto pay there, a loyalty discount on top of that. According to Insurance.com, most insurance companies let you stack multiple discounts, with a typical cap of 30 to 40% total savings. So every little discount you qualify for brings you closer to that cap. Don't leave any of them on the table. Set up autopay. A lot of insurance companies will give you a discount just for setting up automatic payments from your bank account. This saves the insurer money on billing and collections, and they pass some of that savings on to you. Here's the beauty of it. You probably pay your insurance bill every month anyway, right? So all you're doing is automating something you're already doing and getting paid for it. It's like getting a discount at a coffee shop for using their app to order instead of paying at the counter. Same coffee, same price, but cheaper because you made the process easier for them. Plus, AutoPay has another hidden benefit. It prevents you from accidentally missing a payment, and missed payments can lead to a lapse in coverage, which is one of the worst things that can happen to your insurance record. According to Consumer Reports, policyholders who had a 60-day lapse in coverage got hit with an average penalty of $207 more per year. In Michigan, that penalty was $834. AutoPay protects you from that. Your life is not static, and your insurance shouldn't be either. Major life events can change how much coverage you need and how much you should be paying. Things like getting married, having a baby, your kids moving out and getting their own apartment, paying off your car loan, retiring from your full-time job, or moving to a different city or neighborhood. All of these can affect your rates. According to Consumer Reports, adjusting your policy after major life changes could lower your premium significantly. For example, if you used to commute 45 minutes to work every day, but now you work remotely and barely drive, your mileage has dropped dramatically. That means your risk has dropped, and your premiums should drop too. But your insurance company won't know about these changes unless you tell them. So when you get married and your spouse has a clean driving record, call your insurer. When your 25-year-old kid moves out and takes their car off your policy, call your insurer. When you retire and your daily commute disappears, call your insurer. Every change is an opportunity to save. The car you drive affects your premium too, and I'm not just talking about whether it's expensive to repair. According to Consumer Reports, vehicles with advanced safety systems like automatic emergency braking, blind spot monitoring, and strong crash test ratings can qualify for lower premiums. Why? Because cars with these features get into fewer accidents. And when they do get into accidents, the injuries are less severe. Insurance companies see that as lower risk. Lower risk means lower premiums for you. When you're shopping for your next car, factor in the insurance savings that come with advanced safety features. According to IIHS studies, older drivers tend to drive older vehicles that lack life-saving features like forward collision warning, automatic emergency braking, and side curtain airbags. Upgrading to a vehicle with these features doesn't just make you safer on the road, it makes you cheaper to insure. When you're comparing cars at the dealership, ask about the safety rating. It could save you money every single month. If your car has anti-theft features, you might be eligible for another discount. Things like factory-installed alarm systems, GPS tracking devices, steering wheel locks, and VIN etching on windows can all qualify you for reduced premiums. Why? Because they make your car harder to steal. And car theft is a major cost for insurance companies. Think about it from the insurer's perspective. If they're covering 1,000 cars and 50 of them get stolen every year, that's a lot of money they're paying out. But if those cars had GPS trackers and alarm systems, maybe only 10 get stolen instead. Their losses drop, and they reward you for reducing that risk with lower premiums. Check with your insurance company about which anti-theft devices qualify for discounts in your area. Some states even mandate these discounts. And if you're buying a used car, look for models that already have these features built in. A car with a factory alarm system and an engine immobilizer could save you money every month compared to a similar car without those features. Here's a habit that rich people have that most average people ignore. They review their insurance every single year. Not every 5 years, not when they remember, every year. Because the insurance market changes constantly, and what was the best deal last year might not be the best deal this year. Imagine you bought a warranty on your laptop 3 years ago when it was brand new and worth $1,500. Now that laptop is worth maybe $300. Would you still pay the same warranty price? Of course not. But that's exactly what people do with their insurance. They set it and forget it while their circumstances change and better deals appear. Set a calendar reminder. Pick one day every year, maybe your birthday, maybe January 1st, maybe the day before your policy renews, and spend that one day reviewing all your insurance policies. Car, home, life, health, renters, all of them. Compare rates, check for new discounts, adjust your coverage levels. This annual review could save you $500 to $1,000 or more every year. Make it a ritual. Most people don't realize there are 2 types of insurance agents. There are captive agents who work for one company and can only sell you that company's policies. And then there are independent agents who work with multiple companies and can shop around for you. An independent agent does the comparison shopping for you. They get quotes from 5, 10, sometimes 20 different insurance companies and find you the best deal. And here's the amazing part. In many cases, their services don't cost you anything extra. They get paid a commission by whichever company you end up choosing. So instead of spending your entire Saturday calling Progressive, then Geico, then State Farm, then Allstate, then Liberty Mutual, you make one call to an independent agent, and they do all that legwork. They come back to you with the best 3 options, and you pick one. It's like having a personal shopper for insurance, and it's free. If you've never used an independent agent, try it this year. You might be surprised at how much you save. And if you'd rather do it yourself, there are amazing online comparison tools that make it easy. According to Consumer Reports, sites like Compare.com, Experian, Insurify, Jerry, Policy Genius, Way, and The Zebra are dependable and fairly comprehensive. You fill out one form and get quotes from multiple insurers. No single site covers every insurer, so it's worth checking 2 or 3 different comparison platforms. But even using just one of them gives you a much broader picture of what's available than sticking with whatever renewal letter your current company mailed you. Think of it like booking a hotel. You wouldn't just go to one hotel's website and book whatever they show you. You'd check Booking.com, then Expedia, then maybe Hotels.com to find the best deal. Same logic applies to insurance. Use the comparison tools, get multiple quotes, choose the best one. Takes maybe 30 minutes, could save you hundreds. Here is a tip that sounds too simple to be true, but it works. Ask your insurance company to list every single discount they offer, every one, because chances are you qualify for discounts you don't even know exist. I had someone tell me they called their insurer, asked for a complete list of available discounts, and discovered they qualified for a military veteran discount, a paperless billing discount, a good student discount for their teenager, and a home safety device discount, all of which they'd been missing for years. That was over $300 a year they'd been throwing away because they never asked. Insurance companies don't always volunteer this information. They're a business. They're not going to call you and say, "Hey, we noticed you could be paying less." You have to be proactive. So pick up the phone, call your agent, and say these exact words. "Can you please tell me every discount that I might qualify for?" Write them all down. Apply for every one you're eligible for. This one phone call could be the most profitable 20 minutes of your year. If you have a teenager on your insurance policy, first of all, I feel for your wallet. Young drivers are expensive to insure. But if your teen is a good student, many insurance companies offer a good student discount that can knock 10 to 25% off their portion of the premium. So if your son or daughter is maintaining a B average or better in high school or college, that report card isn't just making you proud, it's saving you money. You send a copy of their transcript to your insurance company, and your rate drops. It's one of the easiest discounts to get if you have kids in school. And this applies to college students too. If your child is away at school and doesn't have a car with them on campus, you might be eligible for an additional discount since they're not driving your car regularly. Ask about distant student discounts. Imagine your kid is at a university 300 miles away, no car on campus, only drives when they come home for holidays. You shouldn't be paying full premium for them. Call your insurer and tell them. Here's some good news for married couples. Getting married can actually lower your car insurance rates. Insurance companies view married couples as statistically less risky than single drivers. Studies consistently show that married drivers file fewer claims, drive more carefully, and are involved in fewer accidents. The savings vary by company and state, but some married couples see premium reductions of 5 to 15% compared to what they were paying as single drivers. And if both spouses have clean driving records, even better. You're basically telling the insurance company, "We're a low-risk household," and they reward that. So if you just got married last month and you haven't called your insurance company yet, what are you waiting for? That marriage certificate isn't just a piece of paper for your photo album, it's a coupon for cheaper insurance. Call your agent, update your marital status, and ask them to requote your policy. While you're at it, check if bundling both of your cars onto one policy saves you even more. Newlyweds, this one's for you. Where you live matters more than you might think. According to Bankrate, insurance premiums vary wildly from state to state. According to Consumer Reports, the average annual car insurance premium in Florida, Louisiana, and Nevada is over $3,500, and in New York, it tops $4,000. This is because insurers look at local factors like crime rates, traffic density, weather patterns, and even the number of uninsured drivers in your area. According to the Insurance Research Council, 1 in 7 drivers, that's about 14%, are driving around without liability insurance. And you pay for that through higher premiums. Now, I'm not saying you should move just to save on insurance, but if you are planning to relocate, factor insurance costs into your decision. Somebody thinking about moving from New York to North Carolina might save over $1,000 a year just on car insurance alone. And if you've already moved to a lower-cost area, make sure your insurer knows your new address. A change in zip code could mean instant savings. Here's something important that a lot of people get wrong. In an effort to save money, some drivers drop their uninsured motorist coverage. That is a dangerous mistake. According to Kiplinger, with rising insurance costs, more drivers are dropping coverage entirely, which means your risk of being hit by someone with no insurance is going up.
The smart approach isn't to drop coverage, it's to optimize it. Make sure you have enough uninsured and underinsured motorist coverage to protect yourself. According to insurance attorney Jolie Deutschman, once you have coverage, increasing your limits doesn't tend to increase your premium by very much. So instead of carrying the absolute minimum coverage to save $50 a month, and then getting destroyed financially when an uninsured driver runs a red light and totals your car, you pay maybe $20 more per month for proper coverage. That extra $20? It's protecting you from a financial catastrophe that could cost you tens of thousands. Save money smartly. Don't cut corners on coverage that matters. Let me break down the main types of car insurance coverage so you know exactly what you're paying for. Because you can't save money on something you don't understand. There's liability coverage. That's what pays for damage you cause to other people and their property. There's collision coverage. That pays to fix your car after an accident. And there's comprehensive coverage. That covers things like theft, vandalism, hail damage, and falling trees. So if you're driving a brand new car worth $40,000, you probably want all three. But if you're driving a 15-year-old car worth maybe $3,000, paying for comprehensive and collision coverage might not make sense anymore. You could be spending $500 a year on coverage for a car that's only worth $3,000. If the car gets totaled, the insurer only pays you $3,000 anyway. The rule of thumb? If your annual premium for comprehensive and collision coverage exceeds 10% of your car's current market value, consider dropping it. Check the value of your car on Kelley Blue Book, divide that number by 10, and compare it to what you're paying for those coverages. If the coverage costs more than 10%, it's probably time to let it go and pocket those savings. Insurance companies love selling you add-on coverages that you don't actually need. Things like roadside assistance, rental car reimbursement, gap insurance on a car you've owned for 5 years, and other extras that sound nice, but may be duplicating coverage you already have elsewhere. Think about this. Do you already have roadside assistance through AAA or your car manufacturer's warranty? Then why are you also paying for it through your insurance? That's double coverage for the same thing. Do you have 2 cars in your household and could easily share one if the other breaks down? Then maybe you don't need rental car reimbursement. Go through your policy line by line. Look at every coverage, every add-on, every extra. Ask yourself, do I really need this? Am I paying for this somewhere else already? Removing just 2 or 3 unnecessary add-ons can save you $50 to $100 a year. It adds up.
And combined with all the other strategies we've covered so far, you're looking at massive total savings. For home insurance, make sure you understand the difference between replacement cost and actual cash value. This matters enormously. Replacement cost coverage pays to rebuild or repair your home at today's prices. Actual cash value factors in depreciation, meaning you get less money because your stuff is older. Let's say a fire destroys your living room furniture. You bought that sofa 5 years ago for $2,000. With replacement cost coverage, the insurance company pays you $2,000 to buy a new sofa. With actual cash value, they say, well, a 5-year-old sofa is only worth $800, and that's all you get. You're stuck paying $1,200 out of pocket for a new couch. Replacement cost coverage does cost more in premiums, but the difference is usually small compared to the protection it provides. Make sure you have enough replacement cost coverage to actually rebuild your home if the worst happens. Many homeowners are actually underinsured without realizing it. Have your home appraised or use a replacement cost calculator to make sure your coverage matches your home's actual rebuilding cost. Here's one of the best-kept secrets in insurance: umbrella policies. An umbrella policy gives you extra liability coverage beyond what your auto and home insurance provide. And they are, shockingly affordable for the amount of protection they offer.
Imagine you're in a serious car accident and the other driver's medical bills total $500,000. Your car insurance liability limit is $300,000. Where does the other $200,000 come from? Without an umbrella policy, it comes from your savings, your retirement fund, maybe even your home. With an umbrella policy, the umbrella kicks in and covers the difference. A $1 million umbrella policy can cost as little as $150 to $300 a year. That's roughly $25 a month for $1 million in extra protection. If you have any significant assets, a home, retirement savings, investments, an umbrella policy is one of the smartest and cheapest forms of insurance you can buy. Ask your agent about it today. Whatever you do, do not let your insurance coverage lapse, even for a day. According to Consumer Reports, policyholders who had just a 60-day lapse in coverage paid an average of $207 more per year when they got insurance again. In some states, the penalty was much worse. Insurance companies see a lapse as a red flag. They assume if you let your coverage drop, you're a higher risk, and they charge you accordingly. It's like having a gap on your resume when you're job hunting. Employers see that gap and they start asking questions. Insurance companies see a lapse and they start charging more. If you're switching insurance companies, make absolutely sure your new policy is active before you cancel the old one. According to AARP, driving without insurance is incredibly risky, especially since auto liability insurance is mandatory in almost every state. Never, ever have a gap in coverage, not even for one day. This one catches a lot of people off guard. Many people are paying for more insurance than they actually need. They bought their policy years ago based on circumstances that no longer apply, and they've never updated it. Here's a classic example. You bought your home 15 years ago for $200,000, and you insured it for that amount. Over the years, you paid off 80% of your mortgage, but you also added unnecessary riders and increased your coverage limits every time your agent suggested it. Now you're paying for $350,000 in coverage on a home that would cost $250,000 to rebuild. That extra $100,000 in unnecessary coverage is costing you real money every month. The flip side is also true. Don't underinsure yourself either. But the point is to have the right amount of coverage. Not too much, not too little. Review your policy, calculate what you actually need based on your current situation. Things like what your home would cost to rebuild, how much your car is actually worth, and how much debt you still have, and adjust accordingly. Precision saves money. If you're buying health insurance through the marketplace, you might be eligible for premium tax credits that can dramatically reduce your monthly costs. These subsidies are based on your household income and can save you hundreds of dollars every single month. Many people don't even bother checking because they assume they make too much money to qualify. But the income thresholds might be higher than you think. Somebody earning $60,000 a year might look at that number and think, I'm definitely not eligible for any help. But depending on their family size and where they live, they might actually qualify for significant subsidies that cut their monthly premium in half. Go to healthcare.gov during open enrollment and run the numbers. It takes about 15 minutes. Enter your income, your household size, and your zip code, and the calculator will tell you exactly what subsidies you qualify for. You might be shocked at how much you can save. Don't assume you don't qualify. Check. If you're on a high-deductible health plan, you have access to one of the most powerful savings tools in America, the Health Savings Account, or HSA. This is a triple tax-advantaged account where your contributions are tax-deductible, your money grows tax-free, and your withdrawals for qualified medical expenses are tax-free too. So instead of paying your doctor's bills, your prescription costs, and your dental work with after-tax dollars, you pay with pre-tax dollars through your HSA. A family in the 24% tax bracket saving $200 a month in their HSA is effectively saving an additional $48 a month in taxes. That's almost $600 a year in tax savings alone.
And here's the real secret. You don't have to spend your HSA money right away. You can invest it and let it grow for decades. Pay your current medical expenses out of pocket, keep the receipts, and let your HSA compound over time. When you retire 30 years from now, that HSA could be worth hundreds of thousands of dollars, all tax-free for medical expenses. This is one of the most underused financial tools in existence. Before you file a health insurance claim for a medical procedure, see if you can negotiate the price directly with the provider. Many hospitals and doctors' offices will offer a significant discount for cash payments or upfront payments, sometimes 20 to 40% off the billed price. So let's say you need an MRI and the hospital quotes you $800. You call the billing department and say, "I'd like to pay cash up front. What kind of discount can you offer?" And they come back with $500. You just saved $300 without involving your insurance at all. And that means you didn't file a claim, which keeps your record clean. This strategy works especially well for predictable expenses like dental work, vision care, and elective procedures. You avoid filing claims for smaller amounts, which keeps your premiums stable and your insurance records spotless. And you often pay less than you would through insurance after deductibles and copays are factored in. It's a win on multiple levels. You know what's cheaper than filing an insurance claim? Preventing the thing that caused the claim in the first place. And I'm not just being philosophical here. This applies to every type of insurance you have. For your car, regular maintenance like checking your tire pressure, replacing worn brake pads, keeping your headlights clean, and getting your oil changed on schedule. All of this reduces your risk of breakdowns and accidents. For your home, cleaning your gutters twice a year, trimming trees away from your roof, checking your water heater for leaks, and testing your smoke detectors. These small tasks prevent the big disasters that lead to expensive claims. For your health, annual checkups, regular dental cleanings, staying active, eating well. These prevent the chronic conditions that lead to massive medical bills. Prevention isn't just good advice, it's a financial strategy. Every accident you prevent, every claim you avoid, every emergency you dodge, that's money that stays in your pocket through lower premiums year after year after year. If disaster strikes and you need to file a major insurance claim, do you know what you own? Can you prove it? Most people can't, and that means they get less money from their insurance company than they deserve. Take an afternoon this weekend and walk through your entire home with your phone camera recording. Open every drawer, every closet, every cabinet. Record the contents of your garage, your attic, your basement. Show brand names, serial numbers, and model numbers wherever possible. Then upload that video to a cloud storage service so it's safe even if your house burns down. Keep receipts for major purchases. Keep copies of appraisals for jewelry, art, and collectibles. Create a simple spreadsheet listing your most valuable possessions and their estimated replacement costs. If you ever need to file a claim, this documentation is the difference between your insurance company giving you full value and giving you a fraction. Preparation saves money. Different states have different rules about insurance, and knowing your state's laws can save you money. For example, according to Consumer Reports, California, Hawaii, Massachusetts, and Michigan either prohibit or limit the use of credit scores in setting car insurance rates. If you live in one of those states, your credit score won't hurt you as much. Some states require insurers to give discounts for certain safety features, driving courses, or home improvements. Other states have unique programs that help low-income drivers get affordable coverage. So if you live in California, you benefit from Proposition 103, a law that has saved families over $8,000 in insurance costs over 25 years by focusing on driving records instead of credit scores. Research what your state requires and what discounts are mandated by law. Your state's Department of Insurance website is a free resource that lists all the regulations and consumer protections available to you. Go to your state's DOI website, search for insurance discounts or consumer rights, and you might discover protections and savings you never knew existed. Knowledge is power, and in this case, knowledge is money.
Here's something that catches homeowners off guard every single year. Standard home insurance policies do not cover flood damage. Let me say that again. Your home insurance does not cover floods. If a river overflows and water pours into your living room, your regular homeowner's policy probably won't pay for it. According to Maddox Report, devastating flooding events in states like North Carolina and Texas have highlighted just how important separate flood insurance has become. And with climate patterns shifting, areas that never used to flood are now at risk. You might think you don't need flood insurance because you don't live near a river, but flash flooding, overwhelmed drainage systems, and heavy storms can affect anyone. Flood insurance through the National Flood Insurance Program is often more affordable than people expect, and in many cases, it's the only thing standing between you and financial ruin if water damage hits your home. Don't wait until there's water in your basement to think about this. Check your risk at floodsmart.gov, get a quote, and make an informed decision before disaster strikes. This is protection you can't afford to skip. Similarly, most standard home insurance policies don't cover earthquake damage. If you live in a seismically active area, California, Oklahoma, parts of the Pacific Northwest, you need separate earthquake coverage. And just like flood insurance, it's often more affordable than people assume. Think about this. Your home insurance covers fire, theft, wind damage, hail, but the ground shaking? Nope, not covered. One earthquake could crack your foundation, shift your walls, and destroy your plumbing, and your regular policy would pay nothing. You'd be stuck with the entire repair bill yourself. Review your policy for any gaps in coverage. Ask your agent specifically about earthquakes, floods, sinkholes, and other natural disasters common to your area. Then get quotes for separate policies or riders that fill those gaps. It's like wearing a seatbelt in your car but not having airbags. The seatbelt helps, but without the airbags, you're still vulnerable. Fill the gaps in your coverage before you need them. Most people set their liability limits when they first buy their policy and never touch them again. That's a mistake. As your life changes, as you accumulate assets, as your income grows, as your family situation evolves, your liability needs change too. 5 years ago, you might have been renting an apartment with $2,000 in savings. Minimum liability was fine. But now you own a house, you've got $50,000 in retirement savings, and you just bought a new car. If you cause an accident and the damages exceed your liability limit, everything you've worked for is at risk. On the flip side, according to insurance attorney Jolie Deutschman, once you have insurance, increasing your coverage limits doesn't tend to increase your premium by very much. So going from $100,000 in liability coverage to $300,000 might only cost you an extra $10 or $15 a month. That's cheap protection for your assets. Review your limits. Make sure they match your current financial reality. Gap insurance. If you financed or leased your car, someone probably sold you gap insurance. And at the time, it might have made sense. Gap insurance covers the difference between what your car is worth and what you still owe on it if it gets totaled. But here's the thing. As you make payments on your car loan, that gap gets smaller and smaller. After 2 or 3 years of payments, your loan balance might be very close to the car's market value. At that point, gap insurance is basically worthless. You're paying for coverage that would pay out little to nothing.
Check your current loan balance against your car's Kelley Blue Book value. If the gap between them is small, or if you've switched to owning the car outright, cancel that gap insurance and save yourself the monthly fee. It's like paying for a fire extinguisher subscription when you don't even have a stove anymore. The risk is gone. Stop paying for protection against something that can no longer hurt you. If you're a veteran, an active duty service member, a teacher, a healthcare worker, a first responder, or a member of certain professional organizations, you might qualify for special insurance discounts that aren't advertised to the general public.
USAA, for example, is exclusively for military members and their families and consistently offers some of the lowest insurance rates in the country. Other companies offer 5 to 15% discounts for specific professions. Some insurers have special rates for members of organizations like AARP, AAA, alumni associations, credit unions, and professional societies. So let's say you're a nurse and a member of the American Nurses Association. You call your insurance company and mention your membership. They check their system and, surprise, there's an 8% discount for ANA members that nobody told you about. 8% off your annual premium just for being part of a group you already belong to. Check every membership, every affiliation, every professional license you hold. Any of them could unlock hidden savings. Yes, we're talking about PET insurance too. Because if you have a dog or a cat, vet bills can be astronomical. A single surgery can cost $3,000 to $10,000 or more. Pet insurance can protect you from those unexpected expenses, but you need to shop for it wisely. The biggest tip for pet insurance? Buy it when your pet is young and healthy. Just like human health insurance, pre-existing conditions are usually not covered. So if you wait until your dog develops hip problems or your cat gets diabetes, it's too late. Those conditions will be excluded from your policy. Compare plans from multiple providers. Look at deductibles, reimbursement percentages, and annual limits. And make sure you understand what's covered and what's not. Some policies cover accidents and illness, but not routine wellness visits. Others include wellness coverage for an extra fee. Read the fine print, compare at least 3 quotes, and choose the plan that best fits your pet's needs and your budget. Your furry family member and your wallet will thank you. All right, let's pull everything together into a system. I want you to do what I call the insurance checkup. This is a step-by-step process you can run through once a year, and it will ensure you're always paying the lowest possible price for the best possible coverage. Step 1. Gather all your current insurance policies and lay them out. Car, home, life, health, everything. Step 2. Review every coverage level and ask, do I still need this? Step 3. Check for every possible discount using the strategies we've covered. Step 4. Get quotes from at least 3 competitors for every policy. Step 5. Calculate whether bundling makes sense for your situation. Step 6. Call your current insurer with your best competing quote and ask them to match it. Sometimes they will. Step 7. If they won't match it, switch. Step 8. Set up autopay and paperless billing for instant additional savings. Step 9. Schedule your next checkup for 12 months from now. Do this every year without fail, and you will save thousands over your lifetime. People don't realize this, but you can negotiate with your insurance company. Not every time, not for everything, but more often than you'd think. If you've been a loyal customer with no claims, if you have competing quotes showing lower prices, if your circumstances have changed, you have leverage. Think of it like negotiating the price of a car at a dealership. You wouldn't just accept the first number they throw at you, right? You'd say, well, the dealership down the road is offering this car for $2,000 less. Can you do better? The same approach works with insurance. Call your agent, tell them you've been shopping around, and share the best quote you found. Sometimes they'll lower your rate on the spot. Sometimes they'll find additional discounts they hadn't applied. And sometimes they'll tell you they can't beat the competitor's price, in which case, you switch. Either way, you win. The worst they can say is no. And even a no gives you the information you need to make the best decision for your wallet. Before we wrap up, let me quickly cover the biggest mistakes people make with insurance. Mistake number 1. Staying with the same company for years without shopping around. We covered this. Stop doing it. Mistake number 2.
Choosing coverage based only on price. The cheapest policy isn't always the best. You need adequate coverage too.
Mistake number 3, not reading your policy. I know reading insurance documents is about as exciting as watching paint dry, but buried in those pages are details about what's covered, what's excluded, and what your actual obligations are. If you file a claim and discover your policy doesn't cover what you thought it covered because you never read the fine print, that's a costly lesson. Mistake number 4, filing too many small claims. Every claim goes on your record and can raise your future premiums. Mistake number 5, letting your coverage lapse. Even a short gap can haunt you for years. And mistake number 6, not asking for discounts. Say it with me. Ask for every discount. Don't leave money on the table because you were too shy to ask. Let's add up what all these strategies could save you. Shopping around and switching, potentially $400 to $700. Raising your deductible, $200 to $500. Bundling policies, $200 to $400. Telematics, $100 to $300. Improving your credit, hundreds to potentially over $1,000. Home security discounts, $100 to $300. Defensive driving course, $50 to $200. Removing unnecessary coverage, $50 to $100. Paying annually, $10 to $30. Paperless and autopay, $10 to $20. That's a conservative total of over $1,000 to $3,000 in potential savings per year. And that's just insurance savings. When you factor in the HSA strategy, the medical bill negotiation approach, and the prevention-based mindset, the total impact on your finances could be even greater. This isn't pocket change. This is real money that could go toward paying off debt, building an emergency fund, investing for retirement, or taking your family on vacation. These strategies work. Knowledge without action is worthless. So here's what I want you to do right now. Not tomorrow, not next week, right now. Take out your phone and set 3 calendar reminders. Reminder 1, review insurance policies on the 1st of next month. Reminder 2, check credit report at annualcreditreport.com on the first day of the following month. Reminder 3, get competing insurance quotes 2 weeks before your policy renewal date. Those 3 reminders will put you on autopilot for savings. You won't have to remember to do these things because your phone will remind you. And once you start this annual habit, it becomes second nature. It's like going to the gym. The hardest part is showing up the first time. After that, it becomes a routine that pays you instead of costing you. And here's one more thing. Share this video with someone you care about. A family member, a friend, a coworker. Because everyone is paying too much for insurance right now. And the strategies I've shared today can help anyone save money, regardless of their income level, their credit score, or their current insurance situation. Pass it on. Let me leave you with this. Insurance is one of those expenses that most people accept without question. The bill comes in, they grumble, they pay it, and they move on. But the people who are winning financially, the people who retire early, who build wealth, who live without money stress, those people question every expense. They negotiate, they compare, they optimize. That's what this video was about. Not just saving a few bucks here and there, but developing a mindset that says, I will not overpay for anything. Because those hundreds and thousands of dollars you save on insurance, they compound over time. Invest that $3,000 a year you save into an index fund earning 8% annually, and in 30 years, you're looking at over $360,000. $360,000 from insurance savings alone. You now have everything you need. The strategies, the tools, the knowledge. The only question is, will you use them? I believe you will, because you watched this entire video. You sat here and learned. And that tells me you're the kind of person who takes action. So go out there, lower those premiums, keep that money, and build the future you deserve. Thank you for watching. I'll see you in the next one.